Ever wondered how the price of a cup of coffee keeps rising year after year? Ever thought about what causes this? That, my friends, is the magic, or should I say the curse, of inflation. Inflation is that seemingly invisible force that nudges the price tags of your everyday items upwards. It's like a silent thief, quietly chipping away at the value of your money. But what causes this? Well, for starters, there's demand-pull inflation. Imagine a popular concert with limited tickets. The more people want to attend, the higher the ticket prices soar. That's demand-pull inflation at work. When demand for goods or services exceeds their supply, prices rise. But that's not the only story. There's also cost-push inflation. This happens when the costs of producing goods or services increase, and companies pass these extra costs onto consumers. Think about a bakery. If the price of flour or sugar goes up, your morning pastry might just get a little more expensive. Now, sometimes inflation can be a good thing. Moderate inflation can stimulate spending and investment, which in turn can boost economic growth. But too much inflation, that's where things get tricky. When prices rise too quickly, your money doesn't stretch as far, and that's when you might start feeling the pinch. There are also other factors at play, like government policies and international trade, which can add another layer of complexity to the inflation puzzle. But we'll delve into those a bit later. So, there you have it. A quick primer on inflation. It's a bit like that friend who always insists on picking up the tab at dinner. It might seem nice at first, but over time, you realize that the cost is being passed on to you in other ways. So the next time you notice that your favorite snack is a bit pricier, remember, inflation might be the culprit. But did you know inflation doesn't stop at the price tag of your groceries? It has far-reaching effects that are often hidden from the naked eye. Let's dive deeper into these hidden effects. When we talk about inflation, we often think about the cost of things going up. But there's another side to it, something much more covert and less understood, and that's the role of money printing. Here's how it works. When a country prints more money, the value of each individual unit of currency drops. This, in turn, can lead to inflation as the cost of goods and services increases to keep pace with the devalued currency. Now let's add another layer to this. The world is changing, and the dominance of the US dollar in the global market is not as strong as it once was. This weakening of the dollar's hegemony has significant implications on inflation. Here's why. For years, foreign nations have been buying US bonds, which effectively means they're loaning money to the US. But as the dollar's dominance weakens, these nations are increasingly hesitant to buy US bonds. They're even liquidating their dollar positions, selling off their US dollars and bonds. This global shift away from the dollar can exacerbate inflation. With less demand for US bonds, the US may have to print more money to buy its own bonds, leading to more money in circulation and potentially more inflation. It's a bit like a snowball rolling down a hill, gathering more snow and momentum as it goes. And here's the kicker. All of this can happen without you noticing. You won't see it in the price of your morning coffee or your monthly rent, but it's there, subtly influencing the economy, shaping your financial landscape, and potentially impacting your investment strategy. Inflation is like a ripple in a pond. Its impact is felt far and wide, even in places you wouldn't expect. Inflation might seem like a financial boogeyman, but did you know you can actually profit in an inflationary environment? Yes, you heard it right. So let's dive into some non-traditional investment ideas that can help you capitalize during inflation. First up, we have champagne and wine futures. Now, you might be wondering, what in the world are wine futures? Well, it's simple. You're essentially buying fine wines before they've been bottled. It's a bet on the future quality of the wine. And here's the kicker. Fine wines tend to appreciate over time, especially during inflationary periods. So, as the cost of everything else rises, so does the value of your wine. Now that's something to toast to. Next on our list is fractional ownership in fine art. This concept allows you to own a piece of a high-value artwork without having to shell out millions. Think of it as buying shares in a company, but instead you're buying shares in a Picasso or a Monet. The art market has historically performed well during inflationary periods, making this a savvy move. Plus, it's a great conversation starter at parties. Last but certainly not least, we have microlending. This is a form of peer-to-peer lending where you lend small amounts to individuals or small businesses in return for interest. It's a win-win situation. You get to help someone out while also making a profit. And as inflation rises, so do interest rates, which means more profit for you. So remember, inflation isn't always doom and gloom. With a bit of knowledge and some strategic thinking, you can turn it into an opportunity. Champagne and wine futures, fractional ownership in fine art, and microlending are just a few of the ways you can profit in an inflationary environment. So the next time you hear about inflation, don't panic. Instead, think about how you can turn it to your advantage. Inflation, as we've seen, isn't just about rising prices. It's a complex phenomenon rooted in traditional factors like supply and demand, as well as hidden elements like money printing and shifting global dynamics. In these times, non-traditional investments, such as champagne and wine futures, fractional ownership in fine art, and micro-lending, provide new avenues to profit. Understanding inflation and knowing how to navigate it can be your ticket to financial success. So keep learning, keep exploring, and keep investing smartly.